Hey guys, welcome to lesson number 3, which is on selling Strangles. So Strangles is an amazing option selling strategy and a great tool. To be completely honest, it's not something that I do because I'll explain here in a second. It kind of caps the upside of the market, which is a con for it. But again, this is still a great strategy, one that Tasty Live uses. So that would be Tom Sosnoff and those people that they love. So let's just dive into it because it's worked for me in the past. It's just not one of my personal favorites. Anyways, diving in, what are some things that you need to know? One, it works best in slow markets that are slowly going up or slowly going down, and it works in sideways markets, when markets are range bound. If the market is very explosive to the upside or very explosive to the downside, this strategy will not do well. Who this strategy works best for someone who wants slow, consistent profits and believes that the market is not going to move big in either one direction. So if you think the market is going slower, this is the strategy for you. Cons, one side of the strangle tends to get hit, which means that your stop tends to get hit more than often, especially since the market tends to be bullish. Now, if you're trading it on an asset like gold that tends to be flat over time, you have an advantage. But the overall market tends to trend up over time, so it's harder to kind of make money with strangles. Now, again, I'm just getting into the weeds right now, so I'm sorry. We'll do that in a second. Next, trading account and sizing limits. You need full margin approval. So if you're trading with Tasty Trade, that requires the Works account. ES will take about $6,000 of buying power. If you do MES, it's going to be $600, and SPY takes about $10,000 in buying power. So how is the trade constructed? Well, like almost all strategies, as mentioned in lesson number 1, the base of it is selling a put. We sell a put and we receive income. That's what we do. Now, again, we're not only going to add to selling a put, but we're also going to sell a call. So how does this look on the chart? Well, selling a put means that we pick a level we want the stock to stay above. So this is selling the put. Now, at the exact same time, what we do is we sell a call. We pick a level we think the stock will stay below, just like this. And now we create a box that we want this stock to trade in. That's why I said if it moves slow and we do well, we'll make money. Whether either up or down, it doesn't matter. But if we have an explosive move that breaks this upside or explosive down move that breaks this downside, either way, breaking one of these, that's where we lose money. So a strangle sells a put, which is betting that a stock will stay above a certain level, and selling a call, which bets that a stock will stay below a certain level to create a range that we want the stock to stay between. So that is essentially what a strangle is. So again, we sell a put and we sell a call. The best delta is about 5 to 220 delta for the put, and about a 5 to, I would say more like 10 delta is best for the upper price point that you want to set. Combining the selling call and the selling put creates what we call a strangle. And again, the best days out in the future to do this is roughly 45 to 120 days. This is what it looks like. Again, like I said, we want it capped between a certain range. You can see here we are capped between a certain range. Once we start to break that range, then we start to go negative. So that is what a strangle is. What are some best practices around managing the strategy and managing the trades? So Tasty Live shows that early management is best, meaning that you close the trade out when there's 21 days left. So if there's 21 days or less left in the position, then we'll close it. You can also do a normal stop loss. About a 200 to 400% stop loss is great for this trade. I've had success around the 300% stop loss level if you want to have a hard cutoff for your losses. Next, take profit. You typically manage your profits between 10 to 50%. That tends to be where it goes. When I was trading strangles in the past, I had a 300% stop loss and a 30% take profit, and I did well with that. Next, what are some of the best practices for this strategy? Well, you're going to sell the put at the 10 delta level, so you're going to come up a bit, and then you're going to sell the 5 delta call. So you're giving yourself more room to the upside. I personally like to skew this trade because it gives me more room to the upside. Why? The market tends to move up, so I want to give myself more room up here than down here because the market is continuously moving up. So I do about a 10 delta and a 5 delta. That's how I structure it. If you're following at Tasty Live Mechanics, they do 16 on both sides, which is a 1 standard deviation move. I just don't like that. I tend to have to manage it and close those trades sooner. So I like the 10 delta and 5 delta with a 30% take profit. But again, if we're following the Tasty Live mechanics, which has been documented and they have back test for, you'll be doing 16 delta, 16 delta, 45 days until management, 21 days early management, which means that if there's 21 days or less left, you close it, and you do a 50% profit target. So again, we can automate this entire strategy through the options auto trader. It's actually quite simple. Again, if you have the document linked below, you can kind of walk through each step, or I'll just do it for you. So again, we go into create auto trader. We select our Tasty Trade account. Again, I preloaded this in here for you like most strategies. If you go to our passive income strategies right here, there's a one standard deviation strangle strategy, which is what Tasty Live teaches. You can quickly enable that with one click. But again, for the sake of this, I'm going to create it from scratch so that you can kind of learn how it works. So we're going to sell a strangle as our strategy. We can pick our asset. MES is great for smaller accounts. 45 days out, again, I plugged in my best practices here, so that's about a 10 delta and a 5 delta, a 10 delta put, 5 delta call, could give me more room to the upside. Next, you select how often you want to enter, once a week, 3 times a week, whatever that looks like. Right now it's set up for once a week on Wednesday, so we'll leave that as is. Take profit percentage. Again, I like 30% just because I like to close trades faster. But again, 50% is what Tasty Trade shows for the best practice. So anywhere from 30 to 50% would be fine. And then early management of 21 days. Again, if you prefer a hard stop, then get rid of 21 days and just use a 300% stop loss, and it'll do roughly the same, but it'll give you a hard cutoff. So that's kind of how that looks. Next, buying power allocation. How much money do I want the auto trader to trade with? So again, I'm trading MES, so it won't be much. So I would say 10,000 is always good with MES. If you're doing larger contracts, do 20, 25,000, you should be good. Just like that, you can see here, one strangle takes about $1,000 in MES and will make me about $75. So that's how we structure that trade. That's what it looks like. And again, that's what we can do with the options auto trader. If we like it, we agree with it, we're going to save the auto trader and then set it live and let it do its thing. All right, guys, that is selling strangles, a very easy, very systematic strategy. It can work great for many people, but remember, you want to be someone who believes that the market will not move dramatically in either direction. You're looking for a slower market, and that's how you do it, or you find assets that tend to trade sideways, being metals. That's a great example. Wink, wink. So gold is a great example to trade strangles on. Anyways, guys, I hope that makes sense. I will see you in the next lesson.